Hey guys, how's it going? And in today's video, I'm doing something different than I've been doing the past couple days, and that's going to be going over all the different types of investments that you can make, where you can put your money, and all the different accounts you can put it into. And I'm going to cover a bunch of stuff. Some of the stuff I'll be covering is different types of stocks, bonds, funds, whether or not it be index funds, mutual funds, ETFs even, exchange traded funds, REITs, which is real estate investment trust, which is also traded on the market, and many other things. I'm just going to be going over basically all the investment choices, not necessarily all, but like all the major investment choices that you have. You can watch this video essentially if you're at any walk in the financial journey, whether or not you're farther down the road and you're maybe watching this to get an insight on something to invest in, whether or not it's a certain fund, a certain stock. But generally this video is kind of tailored towards like beginners. This is kind of like a one-stop shop for if you just want to learn a bunch of broad information about investing. So if that's something that you think interests you, by all means, we're about to go over a bunch of stuff, and feel free to stop at any time and take notes or whatever you'd like. I'm just really going to be going over a lot of information in a short amount of time for what I'm covering. I'm not going to go into like extreme depth on a lot of stuff, but I am going to touch a very broad range of topics. With that being said, I'm going to start off the video, and before you start investing, you're going to have an account to invest through, which the three that I chose to discuss, and there's like many accounts, but essentially is going to be a traditional brokerage, a Roth IRA, or a 401k. Now, if any of these sound familiar, which they might because you might have a job that offers a 401k, or you might have watched other videos that say you should open a Roth IRA or you should just invest in a traditional brokerage account. Neither of these, not one of these is necessarily the answer to everyone's financial path that they're on. There's different circumstances for each of these accounts, and I'm going to go over them. So with that being said, I'm going to roll into the two that I use at the moment, which are the Roth IRA and the traditional brokerage account. Now I'm just going to give a couple circumstances for which you should use these accounts, and you can kind of just see if you fit into these. Roth IRA, which is a Roth individual retirement account, is essentially where you take post-tax money. So say you get your paycheck and you get paid $500 a week, after taxes, that's direct deposited into your account. Well, you can take that $500 every week and put it into this account until you hit $6,000 for one fiscal year. So with that $6,000 invested, at the end of the year, you literally don't have to worry about any tax-related documents or paying taxes on any of it. Now, what's really cool about this is when you're 59 and a half years old, you can pull out whatever is in this account completely tax-free. And it's actually going to be quite a bit of money, especially the younger you start, because of compounding interest. And it's pretty awesome. For me, the reason why I opened it up is because I was working at a grocery store, and I was in a fairly low tax bracket because I'm not making a mass amount of money. So I was putting money away towards my Roth IRA. Now I was also putting money away towards my traditional brokerage account, which is the account that I'm rolling in towards. And a traditional brokerage account is essentially a bank account that gives you the option to buy securities, whether or not it's stocks, bonds, ETFs, what have you. So the reason why I had this account is because even though the Roth IRA has the best tax advantages, in the next 5 years, there's some financial goals that I personally would like to hit that the traditional brokerage account provides the best value for me. So for example, if I want to go put a down payment on a house, I know that I can roll money from my Roth IRA into the down payment, but that doesn't necessarily mean I want to, because I want to really get the compounding interest of my Roth IRA for the long term of it being my retirement account. So essentially I can invest in my traditional brokerage account, and I can do long and short term positions because I'm getting taxed on it regardless. And so I know that money is more I can use it for other things. Like if you wanted to buy a car and you didn't want to finance it, you could pull it out of your traditional brokerage account and not be as worried, because it's first off not coming out of your retirement, and second off it's being treated the exact same tax wise as any other amount of money you'd be pulling out from that account. Now with that being said, there's many factors as to why I did have a traditional brokerage account. One is because I probably will buy a new car within the next 5 years. I might go get a house in the next 5 years. And even though I can use the Roth IRA for the down payment if I wanted to, I'd be able to pull money out for moving costs and if I wanted to buy furniture. And it's also just a good place to have my money grow. It really depends on what your goal is, but essentially you can do long or short-term positions within this traditional brokerage account that are suited to your needs, whether or not you're going to park it in there forever, or if you're going to pull it out in the next couple of years. And then we'll just roll right into the last type of account, which is 401k. Now, a 401k is typically through an employer, and what it does is essentially it takes your money before it gets taxed. So your employer has your money before it gets taxed, your gross income. Say your gross income is $50,000 a year, but each paycheck you take home, X amount of dollars, and at the end of the year you realistically only take home like $45,000. Well, it takes money out of that $60,000 each paycheck and it puts it into an investment account. So you're getting a pretty good amount invested. But here's the catch with the 401k. You're getting taxed on the 401k whenever you pull it out at 60 years old, or 59 and a half, I believe. So with that being said, you're like, well, what's the difference between the Roth IRA and the 401k, just like when you're getting taxed? And that's the exact difference, but here's the stipulation. If you want to win with the retirement accounts or know which one's the better bang for your buck, it kind of takes a little bit of speculation, because you have to ask yourself, well, first off, am I making a lot of money right now, and am I going to be making a lot of money when I retire? And once you can kind of figure that out, that's where you can really decide which account's best for you. So if you're making a lot of money right now, the 401k is the best option because it's taking the money out before taxes are taken out of your wages. And if you're in a lower tax bracket, when you pull it out, then you will pay less in taxes on the money itself. Now, the Roth IRA is like the polar opposite. If I'm getting taxed a lot right now, then I'm not taking home a whole lot of money, so I don't want to invest my take-home money into investments. I want to put it into a 401k. But for me, for example, making less than $30,000 a year, working at a grocery store, or even making less than like 50 or 60, you would want to put it into the Roth, and the reason why is because you're in a lower tax bracket, so you're taking home more money than like the upper class. So since I'm taking home more money, it doesn't make sense for me to not use the Roth IRA, because all this money I'm contributing is going to be able to be taken out tax-free when I'm 59 and a half years old. With that being said, 59 and a half years old is a little bit down the line for me, so I did, you have to really think about how long you're wanting this money to sit, and that honestly should have a really big influence on how much money you put into it. For me personally, I was contributing a lot to it in the beginning, but then I started learning more about personal finance, and I was like, I can't even use this money until I'm 60, and I'm going to want to buy a house, I'm going to want to get the house paid off, I only want to deal with cash transactions for buying a car. So there's many things that influenced me to start putting more money into a traditional brokerage account just because of those factors. There's no one definite answer. But I mean, if you're in a pretty solid position cash-wise and you're just saving for retirement, by all means. That being said, those are the three main accounts, and those are the three accounts that you should, heavily decide on whether or not you're going to invest in those accounts. Choose a plan and stick to it. A lot of people's personal recommendation is invest into retirement accounts, like 15% of your income. You can do between 10 to 25. That's essentially the rule of thumb. The Roth IRA only lets you contribute up to $6,000 a year. So depending on how your income is, you could just do that $6,000, and then maybe if you had money left over, allocate it to another account and just set that account aside for retirement. And if you want to invest more money for, just your financial well-being, you can put it into a traditional brokerage and choose your investments from there. Speaking of type of investments, that's going to be the next topic that we roll into. And you're probably here because you want to hear me talk about stocks, because that's what a lot of people are wondering about, and the different types of stocks. So I'm going to break it down into 5 categories. You have stocks, which is at the top right here, and you have 2 different kinds of stocks. You have value and you have growth. So once you have those 2, you can kind of decide what your investing strategy is, and then you can decide what size of stock you want. So small cap, mid cap, and large cap are essentially the 3 main sizes of stocks. Small cap being $300 million to $2 billion, mid cap being $2 to $10 billion, and then large cap being $10 billion plus. Your small cap companies are going to be startup companies, stuff that's fairly new to the game. Mid cap is going to be stuff that's maybe been in for a while, maybe stuff, I believe like General Mills cereal, different tech companies, stuff like that. And then large cap, of course, is going to be your Apple, your Amazon, your Google, what have you. So you can then kind of choose like the sizes that you're going to invest in. And the sizes don't necessarily mean anything. I mean, smaller cap stuff might be a little riskier because it's like smaller companies, but typically it really is not like an insane factor. People do like you to be diversified in the caps, like the sizes of the stocks that you're buying, but if the company is a good company, then that's all there really is to it. Now, value and growth stocks, there's a little bit of a difference because value is going to be a high dividend yield, but it's going to be an undervalued company. So like if you took the amount of shares there are divided, like if you took the value of the company, divided it by the amount of shares, and that dollar amount was lower than how much the share cost, that would be an overvalued stock, vice versa. So if you took that price of what it ideally should be worth and the stock is cheaper than that, that is how a stock is undervalued. It simply is not worth what it's selling for at the moment if you look at the business itself and divide it among these shares. And those are really good stocks to buy over the long term. Then you have growth stocks. Now, growth stocks have a lower dividend yield. Take Amazon or Apple for you. And if you look at the 5-year chart on Amazon and Apple, you will see that they are growing like quite a bit because they are growth stocks. So typically the share price is going to go up, over time, and your return on investment, it just depends. I mean, those are the two different kinds. Everyone's always wondering, do I do value? Do I do growth? And to be honest, my personal take is I do a little bit of both. It just depends. But that all fits your investing style. If you're looking for a definite answer on which one is better, then I mean, there's really not one, and it's really bad to be the bearer of bad news. But ultimately, I guess value stocks are what's more favored by like higher tier investors. Growth stocks are what's valued by like lower to mid-tier investors just because it's consistent growth over time. Now, my thing is like a company is only going to grow so much. And I mean, it's going to continuously grow, but like if you're getting like 300% in 5 years, what's to say the next 5 years it's also going to return 300%? So these are many factors to consider when buying these. While we're on type of stocks, I've said the word dividend a couple times, and you might know what that means, but you might not. Essentially what a dividend is, it's a amount of money that a company pays you for owning, a part of their company in shares. So if you own one share of, say, Apple, for example, Apple's going to pay you a dividend. Well, if you own 10 shares of Apple, which you pay the share price 10 times, and now you have 10 of them, you're going to get 10 times, that payout as well, because each share is going to give you a yield. Now, the yield is essentially the price of the stock versus how much money in dividends do they pay out yearly. So if a company, let's say their share is like $100, and you buy one share for $100, and every quarter, so every 3 months, 4 times a year, they're going to pay you out $2. Well, 1 year, that's going to be $8 total. So since the share price is $100 and you're getting $8 a year from this company, essentially the yield is going to be 8%, which is like extremely high. That's that's just an example. That's not like typically what you can realistically expect to get from these stocks, but that's essentially how you calculate the yield. And most brokerages, how they have the yield for you. And there's a lot of people that only really look at the yield for stocks, which is kind of wrong because like there's many different ways to do it. I don't want to get into it a whole lot, but like dividend yield should not be the only thing that that influences your decision, even though you'll be getting more money like income wise. Because capital gains and the share price going up is something to consider. How well the company ran is something to consider. And many other things like that. I could go into an entire video on just like how to determine if a stock is a good buy or not. But I mean, I probably will, to be honest, but that's not what this video is. This is just the different types of investments. So now that you know about the different kinds of stocks, you know about dividends, you know about the sizes and the two different types, value and growth, we're just going to roll right into the next. And that might be something that you've been waiting for, which is funds. Now there's a couple different types of funds that you've probably heard of: mutual funds, index funds, and exchange traded funds. Now exchange traded funds is like a little subcategory, so I'm going to explain the first two first. So a mutual fund is essentially where someone will pull it together. It's essentially a pie. And in that pie, you take a slice out of like several different companies. So essentially, it's one share price, say, or it doesn't even have to be a share price. For example, the fund itself, you can put X amount of dollars into it, and you'll own like this many shares of this many companies. Say the company, or say the fund has like 10 companies in it, and the balance on the fund is 10% to each company. So if you were to invest $100 it would put 10% of $100, so $10 into each one of these companies. Now, whether or not the company's share price is large or small will determine how many total shares of that company you buy within that fund. Let me give you an example. Let's do 50-50, for example, just so I don't have to go over a bunch of stocks. So let's say there's a fund and it's 50% Ford, which is about $7 a share, and there's one that's like, it's 50% Amazon, which is like $2,400 a share, and you put in $100. So $50 is going to go to each position in that fund. So the $50 buying Ford stock would buy you about 7.5, 8 shares worth of Ford stock. Now $50 in Amazon stock, it's not even going to buy you a tenth of the stock. It's going to buy you like I think it's going to buy you like 2%, to be honest, something really small like that. With that being said, you shouldn't think that, oh, well, since I only own 2% of this stock, I'm not making as much money, I'm not going to get the full potential of the dividends or the growth. But the truth is, and when this is a super big misconception, is like, it's not how many shares you have, it's your current balance of the stock itself. So if you're getting paid, say they're paying out $100 yearly and the stock costs $2,400. Well, say you only put in $1,200, you're still going to get $50 yearly, which is half the amount, which is proportional because you only put in half the amount in the first place. So percentage is like a thing that's very overlooked by new investors, and once you really understand the power of percentages, that's when you can really start understanding, fractional shares and mutual funds and stuff. Now, rolling into the next one is going to be index funds. This one's a little bit easier to explain, so just bear in with me. It's essentially where it takes an index, such as the S&P 500 or the NASDAQ, and that's the pie itself. Like, there's a pie with the top 500 companies, and then whenever you invest into that index fund, it's just distributed between those 500 companies. A mutual fund, the only difference is like people are handpicking the stocks on a mutual fund, and the index fund is more like just tracking an index per se. So index funds are typically pretty safe because, mutual funds and index funds are both pretty safe, but people like to invest in like low fee index funds because over time, companies, even if they do decent, one company going bankrupt isn't going to mess up the fund. And this applies to index and mutual funds, like I was saying. People lean towards index funds for stability and mutual funds for growth, because if there's an industry that's popping right now, maybe aerospace, people are going to want to go into an aerospace mutual fund. But to lower their risk, they might invest into like an overall index fund of every company, whether or not it's oil. Like, there's a bunch of companies within these large index funds: oil, industrials, consumer products, like many different types, so there's different risk factors you can follow, and each fund, of course, has its own amount of risk and it has its typical return. You can look at it, but those are essentially the difference. And now, I brought up ETFs earlier, and essentially what an ETF is an exchange traded fund. So a lot of these index funds and mutual funds, on the investment accounts you have, it's going to say like minimum to enter the fund $3,000 or $5,000. That's to buy like one unit of everything in the fund, or that's just how much the brokerage requires you to have in order to invest in this fund. But maybe I don't have $5,000, so they have this thing called exchange traded funds, where it takes the amount of money that's in the fund and it distributes it like a company. So it puts it into a bunch of shares, and that allows you to buy the mutual fund for a fraction of the cost, and you'll still get the same rate of return because of the percentage reasoning I was explaining earlier, because it's all proportional. So this allows you to get into maybe a $10,000 minimum entry mutual fund for maybe like $50 to $75, which is pretty solid, and it's just easier to track. It's like there's shares in it, and I lean towards ETFs. There's really cool ETFs because it's really cool because you can get into a bunch of different funds for lower cost, and that's personally what I like to go towards, just because like, even though a fund itself is diversified, I can be in a domestic fund, which is a fund that's like all the companies in the US, that's where I'm located, or I can do an international fund and I can get into companies that are all around the world. Now, if I only have $500 to invest, I can't get into a single fund, so the ETF is just like the easiest route to go. Now we're going to talk about some lower risk options that some people might be wondering about, and essentially it's bonds and CDs. A bond is essentially you're lending money towards a company or the US government, and you lock in a rate which they will pay you. You just lock up your money for a couple years. Essentially, like on a 10-year bond, right now it's only like 1.5 to 2%, but this changes, you know, as the market goes up and down. CDs are about the same, 1.25 to 1.5%. CD is called a certificate of deposit, and essentially, like, the easiest way for me to explain it is you just park your money, you just get rid of it, and then like whatever time period you set, say you do like a 5-year one or a 10-year one, well, in 5 or 10 years you'll get, you know, your money back plus the amount of money that it returned. I mean, essentially that's what bonds are. They're typically pretty safe because, like, you know, the U.S. government's pretty much like, it's guaranteed, like, not guaranteed because no investment is guaranteed, but it's like a 99.9% chance that you're getting your money back. So they're really safe investments. That being said, I'm going to roll into the last thing on this list, and that's going to be, should you even invest, and what are some percentages that you can realistically expect to invest based off of your walk in life. And it's going to be easy to talk about someone from a young person's perspective because that's where I'm at. And so that's what I'm going to start off with. Whenever you're young like me, I'm 20 years old. Personally, I'm putting 10 to 15% into my retirement, and the rest I'm just like, because I'm able to invest about 75% of my income. So if I don't max out my Roth IRA, then I'm really like, there's no reason for me not to max out my Roth IRA first off. But 15% is typically a good rule of thumb for retirement. Now, I'm not going to take like all 75% of my money that I'm saving and put it all into retirement accounts that I can't pull out because, you know, I'm 20 years old. I'm going to be buying a house in the next 5 to 10 years. I'm still not like, I still haven't amassed enough wealth to where I can just like completely put everything away for retirement. So me personally, you know, I'm doing like 15% retirement, and everything else is going into traditional brokerage accounts or other investments such as like education and stuff like that. So, I mean, that's personally what I would do. Now, that's just a personal recommendation, like for where I'm at in life. I'm not like, this isn't like financial advice. This is simply knowledge I'm offering that you can take and use it to your, you know, to your power. Maybe if you're 35 years old, I would say, you know, try to throw a little bit more retirement because you're going to want to retire, especially if you don't have a whole lot put into it. And then maybe start like making some steps towards saving up to easier financial decisions, such as like saving up, paying your car off, and maybe saving up enough cash to buy your next car. That way, when your car, you know, comes to the end of its lifespan, you're not in a pinch or anything like that. And then if you're older and you're well, before I even get into that, touching on the 35-year-old thing, you're going to want to invest in like more balanced like investments. Like, since I'm younger, I can invest like in a lot of stocks and stuff like that. Maybe if you're in your 30s, you know, going into 40s, you're going to want to lean more towards funds. And essentially, that's the rule of thumb. The older you get, the lower you want to risk, because you don't want to work 40 years to, you know, amass this amount of wealth, and then, you know, the stocks that you own just go completely down. So when you're 30 to 40 years old, you're going to want to start, you know, like middle level risk, you know, like a majority of funds, maybe start adding some bonds into the mix. And as you get older, you're going to want to do like a majority of bonds and like really safe funds, because you don't want to lose this amount of wealth that you've built up over the years. With that being said, there's no like simple answer to any of these financial problems. There is just different ways to approach it, and there's so many different perspectives on it, and this is just mine. I've went over like the real simple ways to invest, you know, stocks, bonds, the different accounts, maybe giving you a perspective on how much money you should put into an account, or what kind of account you should open, what kind of stocks you should be buying into, and maybe what to look for. With that being said, I'm probably going to wrap the video up here now, but just because I don't have like, I could go into detail on literally every single one of these topics, but I'm not. The idea of this video was to make a basic video telling you the different ways to invest, and I feel like I've covered the most broad topics there are. So if you enjoyed the video, I would really appreciate it if you left a like down below, as well as comment any like super broad investing topics that I might have missed. I'd love to have a discussion in the comments with you, and let's just start a discussion down there. Maybe what you're doing personally, or what you would recommend based off of your life experience, because like I said, I am only 20 years old, so there's a lot of people with more life experience than me, and that's valuable within itself. So with that being said, I'm gonna stop rambling on and end the video. I hope you had a good day.